Hello traders and welcome back to the Forex Geek. In today's video, we'll focus on a crucial aspect of technical analysis that can significantly improve your trading performance. We'll be talking about overbought and oversold indicators. These powerful tools help you identify potential trend reversals and optimize your entry and exit points in the market. Throughout this video, you will gain a deep understanding of how to effectively use indicators such as the Relative Strength Index, RSI, and Stochastic Oscillator to make informed trading decisions. By the end of this video, you will have the knowledge and confidence to incorporate overbought and oversold indicators into your trading strategy. So without wasting any much of your time, let's get started. Let's understand overbought and oversold conditions. In Forex trading, understanding overbought and oversold conditions is essential for making informed decisions. These conditions occur when a currency pair or an asset has moved too far in one direction, potentially signaling a temporary pause or reversal in the trend. An overbought condition suggests that the price has risen too quickly and may be due for a pullback. Conversely, an oversold condition indicates that the price has fallen too rapidly and might be ready for a bounce. So, identifying these conditions on a chart requires the use of technical indicators designed to measure momentum, of which the RSI, which is on the chart right here, and the stochastic oscillator are one of them. These indicators typically oscillate between fixed values with specific levels indicating overbought and oversold conditions in the market. It's important to note that overbought and oversold conditions don't always lead to immediate reversals. In strong trends, a currency pair can remain in these states for extended periods. Therefore, you should use these signals in conjunction with other forms of analysis for more reliable trading decisions. So let's talk about popular overbought and oversold indicators. We've talked about the RSI and the stochastic oscillator. Let's dive deep into them. So the RSI is a momentum oscillator that measures the speed and change of price movement. It oscillates between 0 and 100 with readings above 70 considered overbought and readings below 30 considered oversold. So when the RSI rises above 70, it suggests that the currency pair or asset may be overbought and due for a potential pullback. Conversely, when the RSI falls below 30, it indicates that the currency pair may be oversold and primed for a possible bounce. You can see this on our chart. You can see this level here is an overbought condition. Here the RSI shows us an overbought condition, and you can see price reacting with that condition, giving us the push to the downside because the market is overbought, so we should be looking for selling opportunities. And you can see this area where the market is oversold, so we should be looking for buy trades to push price upwards. Should be looking for buy trade opportunities to push price upwards. And you can see the rising momentum on the RSI also, which is in line with price. You can see. So that is how the RSI works. In addition to identifying overbought and oversold conditions, the RSI can also help you confirm trend strength. If the RSI remains above 50 during an uptrend or below 50 during a downtrend, it suggests that the trend is strong and may continue. You can see in this strong uptrend forming here, we have the RSI frequenting above the 50 level more times than not. You can see it here. We have RSI being above 50 more than it was below 50, showing that this trend is a valid bullish trend and we should be looking for the continuation to the upside. So you can see extended moves as we had here. We had price totally above the 50 level, showing that the bullish trend at the time was a very strong one. So that's how you can use to confirm your trends using the RSI. So the next overbought and oversold indicator in my list is the stochastic oscillator. So the stochastic oscillator is another popular momentum indicator that compares the closing price of a currency pair to its price range over a specific period. So this is it on my chart. You can see this is the stochastic oscillator, and it consists of two lines, the K and the D lines, which oscillate between 0 and 100. So you can see this blue and orange lines, those are the K and the D lines, and they oscillate between 0 and 100. When the K line crosses above 80, it indicates an overbought condition, while a cross below 20 suggests an oversold state. And for the D line, which is a moving average of K, of the K line, it helps to smooth out the signals and provide confirmation. So you can see the D line is the orange line, which helps smooth out the signals given by the K line. And the D line is just the moving average of the K line. You can see the K line is rough, but you have the D line, the orange line, being a smoothed moving average, which helps us understand what exactly is going on with the K line, because the K line can be very volatile and rough, but the D line is smooth. So traders often look for divergence between the stochastic oscillator and price action to identify potential trend reversals. For example, if the price makes a new high while the stochastic oscillator forms a lower high, it could signal a bearish divergence and a possible trend reversal. The same is so for the RSI. I think I have an example of a divergence on the RSI. So this occurs when our price is making lower lows, but the RSI or the overbought slash oversold indicator is making higher lows. So this is an indication that we might be looking for a bullish reversal or a bullish continuation. And you can see this. You can see price here giving us lower lows, but we have the RSI giving us higher lows, and this signals that we might be due for a reversal, a bullish reversal to the upside. And you can see this, as we had that, we immediately had the turn with price failing to break below this low to continue the bearish trend. Instead, price gave us this push to the upside to confirm that bullish trend continuation. So this is for the bullish divergence. We have another example for the bearish divergence here. Okay, look at this example. For the bearish divergence, we have price giving us push to the upside, but we have the RSI giving us the push to the downside. Price was making higher highs, but the RSI was making lower highs. So this suggests that we might be looking for a reversal, a bearish reversal. This is for divergence using overbought and oversold indicators. So this works most of the time. The divergence, the bullish and the bearish divergence, they work when you use them with overbought and oversold indicators, especially like the RSI and the stochastic oscillator. So you can see price giving us the push to the downside after we had a bearish divergence, coupled with price going above the 70, giving us the confirmation to keep shorting the market at that point in time. So when it comes to applying overbought and oversold indicators in your trading strategy, the first step is using them to identify overbought and oversold conditions. The next is using them to identify divergence in price between price action and the oscillator. And the next is applying these indicators with support and resistance levels. So when a currency pair or an asset reaches an overbought level near a key resistance area, it may be more likely to reverse. Similarly, an oversold condition near a strong support level could indicate a potential bounce. So let's look at this. Let's look at an example that clearly illustrates this. You can see this is a clear resistance level we have on the chart. We expect price to come back into this resistance level here and give us the push to the downside. So you can see at the same time we had price being overbought around this area, signaling that the bullish trend here is coming to an end and we should be looking for bearish trend. We also have that coupled with a bearish divergence, which confirms our bearish trend reversal, our bullish trend reversal to the bearish side. So you can see this. After that, we had the push to the downside, and also you can see using this trend line, you can see we had a major area of demand in this area. We have something like a double bottom here. I have a double bottom right here, and you can see as we had this double bottom, we are having significant oversold levels, signaling that the bearish trend which was in play is coming to an end, and we should be looking for buy trades in the market. So that is how you can use the overbought and oversold indicators in your trading strategy. So remember to manage your risk when trading based on overbought and oversold signals. Use appropriate stop loss orders and position sizing to protect your capital in case the market moves against your expectations. Alright traders, you've come to the end of today's video. If you found value in this content, make sure to hit the like button and subscribe to the channel. Don't forget to turn on the notification bell to stay updated with more forex trading strategies and technical analysis insights. Until next time, trade smart and stay profitable.